What is your reaction to this May Mexico surprise?
Well, I think this comes on the heels of a U.S. economy that's already been slowing a little bit over the course of the year. It comes on the heels of some uncertainty about China. We've taken a little bit more of a moderate approach in terms of how we see equity upside from here. We haven't taken down our numbers too dramatically yet, but we think this does add a little bit to the downside risks. And I think it goes to the point where, where are we going to see confidence? Where are we going to see some of the business confidence numbers? I think that becomes a critical question. We'll get some of that news early next week, and then we'll have to see how that plays out from there. But I think that would be the critical thing to look at. And of course, where we've thought about the trade issues coming to bear, at least from a corporate perspective, would be on margins, where we think that the tight U.S. labor market is already increasingly a headwind, although probably not this year, more into next year. But that's how we've thought about the issue.
Do you go into the office this morning, Noah, and say to your team, hey, guys, listen, we've got to start thinking about taking down our numbers for GDP, for EPS, for profit margins? You got to reanalyze those figures this morning.
I think you need to take a look whenever you get a piece of news like this, but we don't want to overreact, right? At the end of the day, a 5% tariff, which may or may not be permanent, you don't want to have your numbers be as volatile as the news flow. So I think the idea here is to be a little bit prudent, but I do think you want to think about what the downside scenarios are. The number we've had out there already on the back of China has been 2650. We think 2650 is where the S&P 500 goes if we see 25% tariff on China. That hits U.S. margins, that shaves EPS by $6 or so, and if the multiple comes down, right? That multiple is a big deal, right? That expresses how confident market participants are in that earnings, in that forward earnings estimate. So 2650 was where we were on China tariffs, and so maybe that floor comes down a little bit. It's not a massively lower floor, but we think that's kind of where those numbers end up.
At some point, do bond yields, 2.16% on the 10-year, at some point, if bond yields get so low, Noah, that you have to buy stocks. Almost inversely, you got to go into the equity market, kind of the TINA. There is no alternative theory.
Right. So I think some of that no alternative theory, or the way I would think about it is, where do you get some return for the risk that you're taking with term premium negative in the bond market? That seems to be where investors are flocking. That said, I would argue that the move we saw from lows to start the year to now probably reflects a surprise from the Fed. And from here on in, what we're seeing in the bond market may be going from, maybe a shift from a reassessment of the Fed's reaction function a little bit more to a reassessment of growth prospects. And I think there, even if bond equities offer you a little bit more return, even a little bit better yield, you're still going to be taking down your growth numbers. So I'd be worried that the paradigm shifts from a moment in time where we saw yields down, bonds, stocks up, to the more normal pattern where if bonds are rallying and yields are falling, that's a negative signal for the forward growth outlook.
I know since December, your model portfolio has actually outperformed the benchmarks by about 2%, so nice job there. You added names like CVS. Would you feel like a CVS or a healthcare company, a Boston Scientific, are they immune to this trade fight?
To the trade fight, yes. To other political crosswinds, no, of course. But I think the idea in a trade war is you move away from the cyclicals, you may move away from those with the global supply chains, and those are the things that also rallied the most to start the year. So even as key leading indicators were slumping to start the year, we saw cyclical outperformance, and that in part motivated us to take down some of our cyclical exposure then. But the same parts of the market, autos, semis, hardware, not software so much, not services, not healthcare, are where we think you'll continue to see some headwinds.